Again, good morning, everyone. Welcome to our webinar this morning entitled A Deeper Look at Public Financing for Disaster Response and Recovery. I am Pamela Manalo of the cpbrd, and I will be your moderator for today's webinar. This activity is jointly organized by the Congressional Policy and Budget Research Department, or the cpbrd, of the House of Representatives and the World Bank, which recently published its Public Expenditure Review on Disaster Response and Recovery in the Philippines, and which has been in the forefront in assisting countries in disaster risk financing. At this point, I would like to welcome the presence of our guests. We have with us our House officials. Let me welcome Deputy Secretary General Edgardo Pangilinan, sir. Thank you. We have Director April Dumas, Director Narcisa Guevara, Deputy Executive Director Mauricio Poluhin, OIC Director Vanessa Defensor, Director Lorena Fernandez, Director Valerie Panginiban, and also, of course, our Deputy Secretary General of the cpbrd, Dr. Romulo Miral, and is joined also by the other officials of the cpbrd. Today, we have participants from the Community Affairs Department, the Reference and Research Bureau, and other secretariat offices of the House of Representatives. Also joining us are the congressional staff, some friends from the Senate Economic Planning Office, the Department of Budget and Management, the Commission on Audit, and the Treasury Office of the Bangsamoro Autonomous Region in Muslim Mindanao. In behalf of the cpbrd and our partners from the World Bank, again, welcome to all our participants and guests in this webinar. To give us the opening remarks, let us hear from the Deputy Secretary General of the Congressional Policy and Budget Research Department, Dr. Romulo Emmanuel Miral Jr. Sir?
Thank you. Good morning. Welcome to today's webinar on Public Expenditure Review, Disaster Response and Rehabilitation in the Philippines. This activity is made possible through the World Bank's Knowledge for Development. Our webinar topic for today is timely and relevant. Amongst all countries in the world, the Philippines is the third most vulnerable to weather-related extreme events, such as typhoons, floods, earthquakes, and volcanic eruptions. Today, on top of these catastrophic threats, we have the reality of the COVID-19 pandemic. It has been estimated that the Philippines is expected to incur, on average, about 3.5 billion or 157.5 pesos billion per year, roughly over 1% of the country's GDP in losses from public and private assets from typhoons and earthquakes alone. However, losses due to natural disasters are not limited to financial losses. Lives are lost, families are dislocated, livelihoods are shattered. With climate change, we can only expect weather disturbances and natural disasters to be more frequent and more severe. Who will forget Typhoon Yolanda, with international codename Haiyan, which hit the country in 2013? According to a World Bank report published in 2018, over 6,000 people died and more than 16 million were affected, causing some 2.3 million people to fall to poverty. Yolanda damaged or fully destroyed over 1.1 million houses and wrought damage to public infrastructure that includes roads, bridges, utilities, hospitals, to the staggering amount of 571.1 billion pesos, or around 4.6% of gross domestic product. Losses in human and physical capital due to natural disasters translate to reduced productive capacity and diminished economic activities. Moreover, when natural calamities strike, inequality and poverty are heightened because it's always the poor who suffer the most. Thus, it is incumbent upon the government to respond swiftly and effectively to natural disasters. The Philippine government is not lacking in initiatives to enhance the country's resilience to disasters. As highlighted in a World Bank study that is the subject of this webinar, Republic Act 10121, or the Philippine Disaster Risk Reduction and Management Act of 2020, provides a strong legal and institutional basis for holistic disaster risk management. From disaster response, the law mandates a shift in focus to disaster risk reduction and preparedness and involves multi-sectoral coordination and active participation at the local level. The Department of Finance has also adopted the National Disaster Risk Financing and Insurance Strategy to strengthen financial resilience. Moreover, the DSWD has developed social protection programs to support social resilience and response to disasters. The House of Representatives has approved also on third reading and has transmitted to the Senate for its corresponding action a bill establishing a Department of Disaster Resilience. It is a priority measure cited by President Duterte in his State of the Nation address. Why is the Philippines' performance in disaster risk reduction and management wanting in spite of these initiatives? Is the budget allocated for disaster response, recovery, and reconstruction sufficient? What would be the best way of raising or mobilizing funds to ensure availability and sustainability? Are funds earmarked and appropriated for disaster risk reduction and management effectively and efficiently utilized? Is there proper reporting and accounting in the use of these funds? In short, are we doing the right things and doing them correctly? The Public Expenditure Review on Disaster Response and Rehabilitation in the Philippines, conducted by the World Bank Group, provides us with answers to these important questions. I'm looking forward to a very stimulating and productive discussion and hope that we will be able to distill important lessons and insights towards crafting better policies and appropriating funds for disaster risk reduction and management. Thank you.
Thank you, Dr. Miral. Thank you for giving us a very good context for our discussion this morning. We are glad to have a team of experts from the World Bank to discuss public finance for disaster response and recovery. The team will present highlights of their findings from the Public Expenditure Review and discuss some of the challenges and recommendations and other country initiatives on disaster risk financing. Let me introduce the team from the World Bank. Our first speaker is Rong Kian, a senior economist at the World Bank in the Philippines, but is now in joining us from Washington, D.C. Thank you, Rong. Rong Kian is the macroeconomics and fiscal management expert behind the Growth and Productivity Report and the Philippines Economic Update, which reviews socio-economic issues and provides growth forecasts twice a year. She leads teams in the World Bank that develop programs to help improve the country's global competitiveness and resilience to natural disasters, and that study the budget allocations and spending effectiveness of local government units, including the implications of the recent Supreme Court ruling on the Mandanas case to service delivery and local development. Our second speaker is Benedict Lucas Signer. Benedict Signer is the Program Director for Crisis and Disaster Risk Finance at the World Bank, now joining us from Singapore. Benedict has supported more than 25 countries in developing and implementing financial risk management solutions to help fund and respond to climate and disaster shocks. He co-led the design and implementation of the Global Risk Financing Facility and leads World Bank support to the Southeast Asia Disaster Risk Insurance Facility, which is Asia's first joint regional risk financing initiative. Benedict leads the World Bank support to the Philippine government in developing and implementing its disaster risk financing strategy. Our third speaker is Richard Walter, the Senior Disaster Risk Financing Consultant at the World Bank, now joining us from Australia. Richard is a general insurance actuary at the World Bank. He specializes in the development of financial strategies to build resilience against the effects of natural disasters in low and middle income countries. As an insurance specialist, Richard has supported the Philippine government since 2014 on the design and implementation of its national disaster risk financing strategy with a particular focus on risk transfer solutions such as the parametric insurance program in 2017 and 2018 and the placement of the Government of the Philippines Catastrophe Bond in 2019. More recently, Richard has been supporting the World Bank's efforts to assist countries in disaster risk financing. Now, let's hear from our team of experts from the World Bank. Wrong?
So let's start with the presentation by me giving you a general context of the macro situation and the recent economic development. So we will have three parts of the presentation. I will focus on the first one, recent economic and policy development, and Benedict and Richard will present the second and third part. So on the first one, on the recent economic development, I think the main part that I want to raise is that the resurgence of the COVID-19 cases in mid-March that led to the reimposition of the quarantine measure held back the early sign of the economic recovery. As we can see in the left figure, which is the that include the Q1 GDP number, it shows that the economy contracted 4.2% in the first quarter due to a prolonged implementation of containment measure and the slow recovery of economic activities. And this is a stronger contraction, or bigger contraction than some countries in the region, including Thailand, that contracted 2.6%, Indonesia 0.7%, Malaysia 0.5%, and Vietnam that grew 4.5%. And the gross contraction was driven by weak domestic demand due to a combination of containment measures, weak confidence, and rising inflation. Meanwhile, the external demand has started to recover slowly, but the service export continued to contract due to lingering restriction to the international tourism that affect the country. Therefore, the first quarter is mainly the public sector that was the main driver of growth. But the early sign of the recovery with a slow relaxation of mobilities and the recovery of earning and employment by the families has been paused due to the return to lockdown in mid-March until end of May, which affect the outlook going forward. Next, please. But we want to highlight also that during this time, next please, Benedict. During this time, the government has responded with two packages that you were all involved in approving, focusing on the health support and also providing support to the poor and affected workers. The response has been measured relatively not bigger than the other countries in the region, but not small either. But it's very people-centered response so far, which is very useful in the sense that the most affected population were given some sort of help during this time. As a result of the fiscal support and also the economic contraction, next please, the revenue collection was grows slower, much slower than the expenditure. As a result of that is the deficit, which lead to the increase of debt. this is also this carried to the first quarter of this year as the government continued to implement the Bayanihan 2 that was extended until June 30th, and the slow pickup of the public investment spending. And this is expected to continue into the second half of this year. Next, please. But I think what is the most important message from my talk is the link to this presentation, is that the economy, although is expected to recover in the medium term, the growth prospect hinges on the country's ability to manage the COVID-19 health crisis. This includes the delivery of the mass vaccination and further loosening of the mobility restriction. But there's a significant downside risk, which include the new variant cases that is popping up around the world that can lead to a rapid surge in cases again, similar to March or even bigger, depending how effective is the containment measure that is put in place. Also, the slower than expected vaccine rollout and the slower global recovery, which will affect the global demand, that will also affect the Philippines' external sector. And more related to this talk is the occurrence of natural and man-made disaster that could further tighten the fiscal space, disrupt pace of the recovery, and more damage to the country's long-term growth potential through physical and human capital loss. As we know, the natural disaster occurrence in the Philippines is not a rare event. It's actually happening every year. So it's the size of the natural disaster that is the main risk, and how the government and the private sector is prepared to respond to disaster. So in today's seminar, we will focus on the role of disaster risk financing in ensuring sustainable and inclusive growth. Benedict and Richard will give an overview of the current disaster risk financing in the Philippines, remaining challenges, and options to further strengthen country's fiscal and financial preparedness to better respond to future crises. And by crisis, it's not only natural disaster, but also health pandemic like the one that we are facing. Okay, over to you, Benedict.
Thank you, Romy. Good morning, everyone, and thank you so much for the kind introduction at the beginning. So I've had the privilege of working and supporting and partnering with the government of the Philippines on this agenda for close to a decade now. So it's a great pleasure as well to be invited here to share some of the experiences and lessons learned, I suppose, with you and help chart the way forward. And as was already mentioned in the introduction, the lessons today for this seminar, for this webinar, draw on a piece of work that was carried out over the course of 2020 in close collaboration with government departments, of course, which is the Public Expenditure reviews on natural disaster, on disaster spending in the Philippines, and also the Philippines Economic Update, which was led by Ron, which was the last one, which was published in December last year, which had a special focus on resilience and disaster. So a lot of the lessons here and the in-depth analysis can be found in those two reports, which of course will be shared with you with the information package after this webinar as well. So today what we'll look at is, I dive a bit deeper into public finance for disaster response and recovery. And the objective of this, of course, just to have the same vision, right, is to ensure the government can respond effectively to disasters, but importantly also efficiently to disasters, that not only does the government have access to sufficient money and resources when something happens, but also that the right channels, mechanisms, systems, instruments are in place to spend this money efficiently, the money reaches the beneficiaries, the people at the right time, and of course to have the right transparency, accountability, and information to make sure that this system can be improved over time. So if you go to the next slide. I won't spend time talking about disaster risk in the Philippines. You know this much better than any of us from the World Bank, of course. But what I did want to highlight for just a couple of seconds is this focus on the financial risk and the financial aspects that we're focusing on, the financial impact. So what you can see here are two charts that come from the Philippines catastrophe risk model that was developed by the government with the support of the World Bank. And these are in fact the same numbers that were already mentioned in the opening. that you can see that in total, the AAL stands for average annual loss, how much the government can expect to incur in losses, or the country rather, in a given year. And you see it's over 130 billion from typhoons alone, over 40 billion pesos from earthquakes. And this kind of information actually helps them inform financial decisions, right? It's a way of translating scientific information, hazard information into financial information to help calibrate excuse me, and inform financial mechanisms. If you go to the next slide, please. It's important to take just a minute, right, and thinking about what does it mean when disasters happen at a time like today, during a pandemic, during COVID. And this, what we look at is what we call compounding shocks or compounding risks. And when one event occurs and another on top of it, and unfortunately we have seen, right, disasters occurring in the middle of COVID, not only in the Philippines, in many countries around the world. And this leads to even worse impacts for a number of reasons, and I've just laid out three here. One, response systems are already overwhelmed. The emergency response, civil protection, healthcare systems, social safety nets that are already stretched to respond to COVID struggle to then, in addition, provide assistance when a disaster, a typhoon, an earthquake happens. Similarly, of course, fiscal resources are limited. Emergency funds already depleted because governments everywhere, not just in the Philippines, are throwing a lot of resources, are responding to COVID for all the right reasons. But again, this leaves limited resources to respond when something additional happens. And last, but certainly not least, very importantly, there's increased vulnerability of people, of households, of SMEs. For example, an SME that had to close due to containment measures loses revenue, is even more vulnerable when in addition, a typhoon destroys physical assets, destroys a shop, a business, a factory, right? So this is important to keep in mind of why pandemics, disasters can interact and make it even worse, and even more important to be well prepared. I'll go to the next slide, please. This is to set the scene of what we're looking at today. And from the World Bank's point of view, building resilience to disasters, to exogenous shocks, requires a comprehensive approach, which brings together building physical resilience, risk reduction, urban drainage, better building codes, seismically resilient hospitals, etc. Together with social resilience, providing the safety nets to households, making sure households can cope when something happens. And all of this also informed by financial resilience, because of course, in order to respond, the government needs to have enough access to sufficient resources. So today, this is what we are focusing on, this bottommost box, which mostly is the realm of the financial decision makers, the Department of Finance, Department of Budget and Management, the oversight agencies. And this focuses on both the availability of resources and the efficient spending of resources. If we go to the next slide, please. These are the key findings from the high-level results on the public expenditure review that was carried out over 2020. And the purpose, the objective of the public expenditure review was to understand in more detail just how much is the government as a whole spending on disaster-related, post-disaster-related appropriation every year. Because that money that comes from different sources, right? Some money goes to dedicated budget lines, the NURM fund. Other money is spent by agencies directly from their own appropriations. And what we try to do here, working closely with the Department of Budget and Management and with the input and support from many agencies, to take a holistic view. How much is the government spending every year on post-disaster expenses only? And the aggregate number here is the estimate is that every year the government spent 0.6% of the GDP or 4.3% of the national budget on disaster response. Now, this does not include pre-disaster spending, risk reduction. This is really response. Likely, this is still underestimating the actual amount the government spends, because a lot of disaster spending in most countries around the world is not explicitly tagged or identified as such. Right? For example, when an agency utilizes maintenance budget that was meant for routine maintenance to instead respond to a small disaster, this may not show up as disaster-related spending. It's very hard to identify. So it's quite likely that these numbers are in fact still underestimating the total the government is spending. But Another interesting fact here that's very important, what we're looking at, is that approximately 1/3 of post-disaster spending comes from pre-arranged funding sources. And most importantly amongst those, of course, the DRM fund, as well as the quick response funds lodged within select agencies. So this is at the national level. And we'll dive a bit deeper into some of those aspects in what is working well and what isn't working so well just yet in the coming slides. Now, before we do that though, if you go to the next slide, please. I would like to take one look at the overarching framework or structure of financial preparedness in the Philippines. And this is evolving and emerging as the government is implementing the National Disaster Risk Financing Strategy. And what you can see here is a combination of financial instruments and sources, which is what we call risk layering, which means bringing together different types of instruments to cost efficiently meet different impacts and effects. And that starts at the bottom layer with budget mechanism, retention, disaster funds, the NDRM fund, at the quick response funds, at the local level, the LDF funds, of course. And these funds are good for quite frequent disaster events. But of course, when something very severe happens, like a Typhoon Haiyan, for example, this is not efficient to save for something so severe. Something only happens every 10, 15, 20, 30 years on average. This is when other financial instruments become more efficient, more effective. For example, at top end, the sovereign risk transfer and the Philippines catastrophe bond, which was issued in 2019, which is a way of transferring risk, sovereign risk, to capital markets, which becomes effective and efficient way of managing very rare events. But when they do happen, it becomes very costly. So this is a way of managing those unexpected shocks. And there's other financial instruments that the Philippines is developing, including public asset insurance, including developing the domestic insurance market to transfer more risk from homeowners to well-functioning private insurance markets. And of course, also contingent financing, an instrument the government has utilized for quite a number of years, both from the World Bank, but also from other partners, the Asian Development Bank, JICA from the government of Japan, which is pre-arranging loans and lending to quickly inject funding following a shock when something happens. The last point here, very important, that all of this has to be informed by good information on risk, good information on assets, what the government owns, in order to allow analytics, analysis, to calibrate those instruments, to estimate the actual potential damage, right? Just like the figure, the map I showed at the beginning. And in the Philippines, the government has been investing very heavily in this through two main streams of action. One is around risk information. So this is, for example, the Philippines Catastrophe Risk Model, but also, of course, the initiative led by DOST on Geo-Risk Philippines, really bringing the national scientific agencies together. And then under the DBCC and with BTR and DBM, the NARS, the National Asset Registry System, as a central registry of all the assets the government owns, all the buildings, infrastructure, developing a single point of truth for that and improving the management of those assets through the Philippines government asset management policy, which was recently adopted last year and is being implemented under the oversight of DBCC. Now, if you continue, please. So all of this to say is the Philippines is doing a lot. And in fact, many countries, not just in the region, but across the world, are looking to the Philippines as a leader in building financial resilience to disasters. But it's still important, right, to focus on those areas where bottlenecks remain, and especially be better prepared as climate change, unfortunately, makes some of these disasters worse, but also importantly, as economic growth, population growth puts even more assets and people in harm's way. So it's important to focus on those areas that can still be improved. And this is what I'll look at over the next few slides or so. So if you continue, please, and you just go to the next one. If you just go, yeah, exactly, up to it all on the screen. Thank you. So first, we're looking at the challenges around the public financial management of disasters. And I will go through these. I will dive in a couple of those in more depth, but really all the information also, of course, can be found in the publications I mentioned, and very much looking forward to hear from the panel discussion afterwards as well from the government agencies on this. So first key finding is that contingent liabilities from disasters, so the potential cost that may occur, is not fully quantified in the Philippines, and it's not integrated into the management of fiscal risks. it's not properly accounted for. Now, this is very common in most countries around the world, but we do want to encourage as best practice to move towards fully understanding contingent liabilities from disasters and climate risks. Second, there is incomplete data on disaster impacts and spending. So the public expenditure was one step towards better understanding past spending, but this was quite an ad hoc snapshot. There is no comprehensive data of disaster spending every year, but equally there's a lack of disaster impact data, which makes it very difficult to assess the adequacy of spending. Right? If you don't know what is the actual damage, social, economic, infrastructure damage of disasters, it's hard to compare this to spending and assess, is the government actually spending enough? Is the money, is there sufficient money available? Third, for pre-arranged funding mechanisms, which as we saw is about 1/3 of post-disaster spending, the budget allocations are not evidence-based. They're not made on past disaster spending and future probable spending, and often they have proven to be insufficient. And even when there is money in those pre-arranged mechanisms, complex approval processes often delay the release of funding, which cause additional delay in response. So if we go to the next slide, this is one area I look a bit more in depth. Next slide, please. And this is the example of the NDRM fund, which of course is the primary mechanism of the budget to allocate funding to disaster response. There's a couple findings, right? A couple points to highlight, which are worth looking at in more detail. One is the allocation to NDRM funding. The quick response funds are based on fixed amounts of previous year's needs. It is not based on a risk analysis, analytics on how much might be needed in years to come. The process of fund approvals is too long. Delays of up to 1 year or more have been reported against the prescribed timeline for national government agencies of 15 to 30 days. So clearly there's a big bottleneck there. And one reason for this is quite complex approval processes. Funding requests to the NDRM fund need to be evaluated by OCD and the NDRMC, approved by the Office of the President for every single request, and finally DBM can then release the budget authorization and the spending. And this forces agency often to find alternate funding sources due to delays and potentially afterwards repurpose NDRM funds funding later, which of course causes concerns around transparency and accounting. There also seem to have been significant authorized but not released amounts of NDRM funding, again, potentially pointing to further weaknesses in the approval processes. Now, if you continue the next slide, please. And I want to take a quick look at challenges at the national and subnational interaction. And here, a key challenge is that national subnational cost sharing is unclear. There is no clear rule on who pays for what, when, and how much when a disaster happens between the national governments and local government agencies. And as part of the public expenditure review analysis, we found that the national government seems to pay between 70 to 100% of disaster response. Even though, of course, local governments, LGUs, all have funding set aside. But this may not account for all spending by LGUs because it is, in fact, very hard to find comprehensive information, and a lot of this is unreported. And go next slide, please. And at the local level, LGUs face significant constraints in allocation, management, utilization, and transparency of disaster response funding. And there are capacity constraints, but there are also more structural constraints. For example, every LGU by law has an LDRM fund, which is a fantastic preparedness measure, but it also means there's a huge amount of separate processes and funding pockets which hold a lot of money, over 1% of the annual national budget, but which may not be managed very efficiently because, of course, this poses operational accounting constraints on some national governments. And it's also not very financially efficient because the money is held up in separate pockets. Okay, so we continue the next part, please. And this is really focusing forward-looking. It's the last section I want to talk through. First, key recommendation: ensure adequate funding is available for efficient disaster financing. And this includes both climate disaster risks. Sorry, what this means, including climate disaster risk in a dedicated fiscal risk management function. A clear mandate for risk finance planning is the overarching recommendation here, right? To quantify and include contingent liabilities to disasters, climate change, and other shocks, exogenous shocks, such as pandemics and COVID, in the fiscal risk management process, planning process that already exists under the DBCC. In past years, the fiscal risk statement has included disasters in a qualitative discussion, but it is not fully quantified and based on an available data and risk analytics. So this should be the first step to then inform the financial planning of the government. If we go to the next slide. Once this information is captured in the fiscal risk report, this should be taken up by a dedicated unit or bureau or office with fiscal risk management function. This does not have to be a new unit, right? This doesn't have to be newly established. This can be an existing agency, an existing working group, for example, with oversight under the DBCC, but with the clear and explicit institutionalized mandate to carry out regular fiscal risk planning, financial preparedness planning as part of the oversight agency process and fiscal management process every year. And of course, this should be led both by the financial management agencies with very close coordination on the downstream side with the technical agencies, OCD, DOST, DPWH, etc. Now, if you focus on the next one, please. And while having this information in the fiscal risk report, having a mandated unit or function to look at this, then this would allow the government to carry out annual fiscal disaster risk finance plans, which coordinate the overall risk financing activities, which ensure that the allocations to the NDM fund, for example, are efficiently coordinated with external financing sources, with contingent financing, with risk transfer, and all of this comes together into the most effective and most efficient financial plan and risk layering strategy. So we continue, next one, please. Secondly, important, focusing on the efficient spending of post-disaster resources. And here it's important that, of course, disaster response, the spending is only one part, and there's many other actions that need to be taken to ensure effective post-disaster response. But here we focus on the financing. And one part is improve the process to monitor, report, and control public disaster spending. Basically, to ensure the government has complete transparency over how much is being spent, when, and how, in order to improve future planning. A second key recommendation is to strengthen the NDM fund by streamlining operational procedures and revising the design and operations of the NDM fund. And a bit more in depth here. One key point, revisit the allocations to the NDM fund by not just looking how much was allocated last year, but actually looking using disaster risk analytics, actuarial analysis, and forward-looking analysis of how large are the potential impacts, right? And this builds on what we just discussed around fiscal risk quantification and analysis. So how much should be allocated? And this analysis can be done by financial management agencies in collaboration with the technical agencies. In addition, the government want to update damage approval and funding request processes, for example, through the use of technology to simplify and streamline damage reporting, and then link to that streamline the approval processes to meet the actual prescribed timelines, to reduce the approval steps, especially for lower level requests, right? And maybe make the approvals required relative to the funding requested, the amount requested. And also ensure that the funding allocations and approvals become a purely technical decision taken at the technical level, so it doesn't have to go to the political level and to outside offices. If you continue, there's two more points on the NDM fund as well. What we recommend is to directly link the funding from the NDM fund to existing programs, so pre-arrange the processes, the triggers, the decisions when funding can flow, for example, to the emergency cash transfer program, which was set up by the DSWD under the 4Ps program, so that there doesn't have to be an ad hoc funding request, but there's already built-in mechanism to the NDM fund that can say a trigger occurs and funding will be released to DSWD to implement its response. And last, the government want to consider to redesign the NDM fund as a financial vehicle that can efficiently leverage the budget allocation and channel funds from outside instruments. So for example, the contingent lines of credit or risk transfer, to go through that same fund and reach the same pre-arranged disbursement channels to agencies in an efficient manner, and also utilize some of the funding allocations to pay for insurance premiums and risk transfer to transfer some risks out of the country. Next slide, please. Then if we look at the local government units risk financing and ways to strengthen this, One is a very important measure is to clarify the cost sharing between the national and local governments and start putting down in regulation or in law how much the national government will pay and how much local governments are expected to pay. Now, in no country does this work black and white, but having clarity of what is required for the national government to step in provides also clear incentives for local government units to utilize their own funding and, of course, to invest in risk reduction. As long as there's an expectation on behalf of local government units that the national government will always come and step in, of course, this creates disincentives to spend your own money on preparedness. So providing clarity can really improve risk ownership. Then the second point, investing in strengthening financial management, reporting capacity of LGUs. And third, explore ways for LGUs to establish a joint structure for LDM funds to work together and pool parts or all of the resources. And the national government could incentivize such a structure, for example, through matching of funding, matching of resources, providing support to transfer some risk to the outside, risk to insurance markets, or providing, for example, contingent financing from the national government, making contingent and linking it to such a joint structure. In order this to improve the transparency, the effectiveness, efficiency, and the financial planning of the LDM funds. And next slide, please. And last recommendation is to continue working to leverage financial markets, private sector, not just for capital, but also for its expertise. And here are three parts. One is to scale up financial risk management of public assets, and especially through the rollout and implementation of the National Indemnity Insurance Program, which is already under preparation by a technical working group under DBCC, led by DBM, DTR, working with GSIS and DOF. And this really should be implemented and rolled out as quickly as possible to provide protection to critical assets. Then increase financial protection of homeowners and SMEs. A lot is happening in this regard already, but still it's quite undeveloped and incipient stage. And further develop agriculture, risk finance, and insurance solutions. And in particular, ensure that what exists in this space really protects smallholder farmers and subsistence farmers. I think there's quite an area which could use additional focus and reforms. Now, I leave it at this. Next slide is just a summary of the same recommendations again. So ensure funding is available, ensure funding is spent efficiently, strengthen local government risk financing, and leverage external financial markets for that. With this, I'll pass it on to Richard to look at how we can learn from this experience and apply some of this to the current and future pandemics to be better prepared against pandemic shocks. Thank you so much, and look forward to any questions at the end. Richard, over to you.
Thank you very much to Rong and Benedict for the presentations, and thank you for the introduction at the beginning. So yes, my name's Richard. I've been working with the government of the Philippines for around 5 or 6 years now, specifically on the area of disaster risk finance, and with a special focus on insurance and risk transfer solutions. So helping the government transfer some of the natural disaster risk to the private sector internationally. So my section of the presentation is going to be focused on how these principles of risk finance apply to the case of pandemic. So of course, the impacts of COVID-19 are still very much being felt. And while the recommendations that Benedict put forward are at a broad sense, they really also encapsulate the general recommendations for risk financing for pandemics as well. What we'll see in over the course of my presentation is that really the principles of pandemic financing are not very different from the same work that we would do to try and effectively and efficiently finance other kinds of natural disasters such as typhoons and earthquakes. But there are some intricacies and some unique aspects of pandemics that we can delve into a little bit more, given everything that has been going on over the past year or two with COVID-19. So next slide, please. So this is a quote from the OECD, which is specifically to do with the impact of COVID-19 on businesses. And we saw from Rong at the beginning of the presentation that the impact that COVID-19 has had on GDP in the Philippines, with this huge contraction of the economy, much of this is felt by businesses, and that is because they lack insurance protection from these kinds of events. So businesses in the private sector can access what's called business interruption insurance, where for some reason they are unable to carry on their businesses, and therefore the insurance would compensate them for that. The problem is that typically business interruption insurance does not cover pandemic risk, and that is usually because business interruption insurance is part of commercial asset insurance, which requires damage to a particular asset to be incurred in order for the business interruption part of an insurance policy to be valid. So what that means is if there is an earthquake, for example, and a business is housed in a building which is damaged or destroyed, and that business can no longer continue their business for a period of time, then if they had commercial asset insurance, then or commercial business insurance, then they would be covered from that interruption in their activity. But in the case of the pandemic, there is no physical damage, and that means that often this kind of insurance policies will not be valid and do not provide payouts to businesses who are forced to close because of the government directions. And so what that means is that really it's businesses and the follow-on effect that has on individual welfare and livelihoods. That is really where the brunt of the loss is felt. Next slide, please. So what we're going to be looking at is how can public finance be arranged or planned effectively to support risk management for future pandemics. So I'm not going to be discussing the specific case of COVID-19 and how the government of the Philippines has responded to that. What I'm really going to be focusing on is how we can learn from this experience and plan better for future pandemics, knowing what we know now. So next slide, please. So as I mentioned, much of the theory that I'm going to be going through here, or the key lessons, are applicable just as much to other kinds of disaster risk as pandemics. But one of the things that is unique about a pandemic is that much of the economic impact does not come from the pandemic itself, but it comes from the direction from the government to close businesses. So the lockdown, as the phrase that has been used globally for these kinds of government directives. Now, those decisions are, of course, completely necessary. These decisions, in the case of COVID-19, have led to a huge number of lives and livelihoods being saved. But but really, the key risk is how quickly this action is taken. And if we consider two different countries who have responded quite differently to COVID-19, and I'll take two countries that are close to my heart. So I'm originally from the UK, but I live in Australia. And considering what these two countries have done, at the onset of the pandemic, the government of Australia, along with New Zealand, has received a lot of praise for how the governments were able to contain the virus, and that was largely done through very decisive and early action to lock down. Now, obviously, there are many different factors at play in this, and so it's not just this the action of the government in this regard. But if I compare to my family back in the UK, where there was not such decisive action taken, there has been a much prolonged impact of the virus, and they have come through a much longer period of lockdown in the end. because of how the situation went out of control. And so really what we are, the key risk when it comes to a pandemic of this nature is whether action is taken decisively and quickly enough at the outset. Now, one of the reasons why this is such a difficult decision is, of course, the impact that lockdowns have on the economy. So that leads to hesitancy over such decisive action. Now, one of the key learnings from disaster risk finance is that having prearranged finance in place can actually help these actions be taken more quickly and decisively. So as an example, if you already have in place a program that can help businesses if there is a government lockdown imposed, and there is already financing in place that can help finance that particular support program, then the government is much more likely to be able to say, okay, we're going to impose a lockdown, because there is it is then felt as though or we know that the future impact on those businesses will not be as significant as if this financing was not in place. So this is definitely one of the very unique aspects of a pandemic, and that's quite different to natural disaster risks such as typhoons and earthquakes, which is what we before COVID were usually focused on. Next slide, please. So one way of structuring our thinking about this is to identify the key priorities for the government in such a situation. So we can think about, okay, if there was going to be another pandemic in the future, which sectors of the economy are our priority for supporting, and then we can look to how we would finance these support mechanisms. And on this slide, you see different stakeholders. So on the left is the government. Of course, the government needs access to rapid liquidity in order to conduct emergency response and support the healthcare sector, and also build resilience for the future at the same time. Supporting agriculture, of course, domestic agriculture and imports and exports have been impacted enormously by the closure of international borders and transport links. Businesses and human capital, this is what I was mentioning just a moment ago, where businesses close down and people lose their jobs. How can we support these businesses to be able to bounce back very quickly as soon as the lockdown is lifted and the economy starts to reopen? Supporting individuals, in particular the most vulnerable, perhaps those who didn't have supportive employers previously. How can we ensure that they are supported? And really key throughout this is ensuring a supportive and stable financial sector. So how can we ensure that the banking sector continues to operate, continues to provide loans to businesses and individuals to keep the economy moving, despite perhaps government action to try and limit the impacts of a pandemic. So supporting these groups of stakeholders, they're not mutually exclusive, and in fact, they all are necessary in order for a country, the economy, to bounce back. The question is therefore more around prioritization. Of course, the government has limited financial resources. We work to try and increase those financial resources as much as possible for these kinds of support mechanisms. But ultimately, this is a case of deciding on government's objectives before we are able to think about how these should be financed. So next slide, please. So these are the principles that we usually work towards for effective disaster risk finance, and these are not necessarily or they're not specific to pandemic risk, and the same can be applied to natural disaster risk or other kinds of shock events that would impact the national economy. And principally, the most important one of all is that speed matters. So putting in place financial plans, arranging financial instruments in advance allows the government to respond quickly. So when we think about all of those stakeholders on the previous slide, how can the government act quickly to support those stakeholders? The key is advanced planning. The second is that we must ensure there is a structured response. So again, in order to support those stakeholders, it's quite clear that there is no one instrument that can support all of those groups. So for the government to raise rapid liquidity in order to support the healthcare sector on very short notice, that requires a different kind of financial source compared to supporting agriculture or supporting individuals. So we need a package of instruments, and this links back to the what Benedict termed as the risk layer diagram, where we saw the government already has in place a number of different financial instruments that work together to effectively finance the risk that the country faces. All we are suggesting here is that the pandemic side of the pandemic risks need to be included within that thinking. So when we are thinking about the government's national disaster risk finance strategy, we know we need to include pandemic risk in there, and ensuring that there are a variety of financial instruments that can support these different stakeholders is a key part of that. The third principle is around dispersal mechanisms. So how would you actually reach the intended beneficiaries of these support programs? So again, you might have some sort of program for people who are out of work because of the government lockdown, or in case of the agriculture sector, there may be programs to support subsistence farmers, for example. All of these different financial sources that are used to support these individuals need some sort of mechanism to actually go the final mile and to get the support to those individuals. And that is just as important as wherever the finance comes from or wherever it's raised from. And the last point is around technical analysis to guide all of this thinking. So Benedict introduced at the beginning of the talk around the slide with the maps of the Philippines and the information about the potential losses from typhoons and earthquakes. This kind of information is key to be able to guide decision making over this prioritization of resources. And so this is an area where the government has done a huge amount of work in the last few years. And so this is definitely not something completely new to the Philippines. There's many people who work on this already within the government. And of course, there are development partners who have supported the government and continue to support the government through that process as well. Next slide, please. So how can future pandemic risk be financed? So we've learned a lot from COVID, that obviously the situation is still ongoing. How can we use that information to guide our strategy for the future? Next slide, please. So principally, this is an issue for the government or for the public sector. So obviously, in an emerging pandemic situation, key is to support the health sector, businesses, and individuals, and this support will have to come from the government. And what that support looks like is dependent on the government's objectives. So this comes down to what I was mentioning before on the slide with the different stakeholders. There needs to be technical analysis done with political leaders as well to really pin down what the government's objectives are in such a situation, and from that we can then develop a strategy which then we can look to finance. So, but this is a long process. So there is no kind of button that you can press such that suddenly we are at a point where everyone knows what the risk is. The government has clear objectives. We know how it's going to be financed, and then we're just waiting for the disaster of the pandemic to happen. And once it does, we'll be super efficient. We're not going to get to that point just by flicking a switch. This is a long process, and the government is already going along this journey. And so the first step is really around identifying and then trying to address the risk that exists. And the government is already doing this, particularly with key natural disaster risks such as typhoons and earthquakes. There's been a lot of work done in terms of risk assessment, understanding areas in the country which are highest at risk. For example, the eastern seaboard, we know, is at higher risk to typhoons. All of this assessment of risk is the key starting point of this. Once we start to look at financial mechanisms which can help finance this risk, again, it will principally sit with the public sector, but eventually we can bring in the private sector, not necessarily to finance all of that risk, but as a way, as a conduit for providing support to beneficiaries. Next slide, please. So there is a couple of countries who are starting to look at this this very last point around how can we involve the private sector to not necessarily lessen the burden on the public finances, but as a way to efficiently support businesses who have been impacted by a pandemic. So a couple of examples that are still very much emerging at this point. They have not been put into place yet, either of them, but these countries are starting to think about these. And so this is a couple of examples from the UK and the US, and they're actually very similar to each other. The idea is to have domestic insurers provide this business interruption insurance to businesses, but that would also cover for losses occurring from government action related to a pandemic. And the losses associated with those policies would then be pulled together and go into a pool which is backed by the government. So in both cases, the wording that has been proposed is slightly different. In the US, it's actually an act that has been introduced to Congress, but the concept is the same. It's what's known as a federal backstop, or some sort of public backing for an insurance pool that would cover the risk of these policies, perhaps above a particular level of loss. And so, so this point is key, that it's still the highest level of risk is still the responsibility of the public sector. It's still coming from public finances. But the advantage of arranging it in this way is that the support is being channeled through private sector domestic insurers to businesses. And so that mechanism of this, what I referred to before as a disbursement mechanism or a support mechanism, that part doesn't necessarily have to involve the government. And over time, what we can see is that the private sector eventually can put more and more capital towards these kinds of initiatives, and that there is less reliance on the public sector. And a key example of this is actually through how terrorism insurance first was introduced and how that has evolved over time. And it's essentially exactly the same. So when after 9/11, there were businesses who were seeking for similar kind of business interruption insurance, but related to acts of terrorism. And it was deemed effectively uninsurable unless governments stepped in to support that high level of the level of risk, or to provide capital for insurers to be able to offer policies for this. And what we've seen over time is a shift where the private sector is taking on an ever greater share of that risk from the public sector. So these emerging examples are certainly not in place yet, but this is just some initial thinking that has been done by, and it's not just the UK and the US, there are a few other countries as well who've been considering this. Next slide, please. So I'll finish with a few key recommendations, and this is specifically for pandemic financing for the future. So the first recommendation is to understand how support for COVID was provided. Again, we can think about those stakeholder groups, so the government, agriculture, businesses, individuals, and if there was support provided to stabilize the financial sector. What did the government actually do for COVID, and how appropriate and cost effective were those those processes, were those support packages? And from that, we can understand or consider whether reform should be put in place to embed these mechanisms into longer term risk management. And that doesn't necessarily have to just be for pandemics. So there may have been support programs that were put in place because of COVID, which are just as effective for other kinds of hazard events, for example, floods, or even minor scale floods or landslides, or larger events such as earthquakes or typhoons. There may be support mechanisms that were introduced because of COVID that are effective and valuable and can help protect lives and livelihoods for other kinds of hazards as well. The third recommendation is to revisit the National Disaster Risk Financing Strategy and the government's fiscal risk planning and ensure that this includes pandemic risks. So when this was first developed, of course, we couldn't imagine the potential impact of a global pandemic, such as what we've seen in the last year. And much of the focus of the National Risk Financing Strategy was on natural hazard risk. And so I think we can learn from COVID, we can learn from the situation that we're still in, to ensure that for the future, these strategies and mechanisms that are put in place are effective for pandemics as well. Similarly, the government has in place risk insurance programs. So we mentioned earlier around the catastrophe bond that was placed in 2019. That was preceded by some other insurance programs, such as that for LGUs. And knowing what we now know with COVID, we can start to look at including pandemic risks in these kinds of instruments. So there has been a couple of examples of these sorts of insurance policies that pay out for pandemic risk. They're still in their infancy, and there are learning points from those programs, but there have been cases where there are insurance policies placed which are cost effective, competitive. The international market is interested in providing those policies, and so that is something that the Philippines can start to consider as well. And the final point is on exploring new sources of financing, not just for pandemics, but for all kinds of disaster risks. And so as part of this, I would think about how much the private sector or private sector capital can be leveraged. There is also lines of contingent financing. So these are kinds of emergency loans or grants which are provided on certain conditions being met, such as a state of calamity. The Philippines has had these contingent lines in the past, including two with the World Bank, and so these are effective for supporting the government to provide rapid response on the onset of some kind of disaster event, which could be a pandemic or could be some other kind of disaster risk. So there are a few different sources of finance, and of course there are many development partners that are already supporting the government of the Philippines and will continue to do so through what hopefully is a short-lived pandemic. It's already been going on for too long. So hopefully we can reverse that economic contraction that Rong mentioned at the beginning, and start to see individuals and businesses recover quickly. So I'll finish there. I think I will pass back to Rong, our first speaker, just for a couple of minutes, just to wrap things up before we finish this part of the session. Thank you.
Thank you, Richard. So I will just summarize a little bit. I think Benedict gave a very good overview of the current state of the disaster finance in the Philippines, and Richard gave us a lot of idea of going forward, what additional instrument and strategy the government can adopt. I think next slide, please. I want to emphasize that it's a comprehensive risk finance need to include climate and disaster risk in a dedicated fiscal risk management function and a clear mandate for risk finance management. So I think we've seen that the disaster risk financing has been implemented by different agencies with different mandate, and there's no one overarching agency that oversees different instruments, strategies, to make sure there's consistency and also there's no duplication, and also that most of the risks are covered. So that's why we believe that to further strengthen the implementation of reform to build fiscal resilience and inform public finance decisions, such as efficient allocation of resources to risk reduction and response, the government should include disaster-related risk consideration in the fiscal risk statement. Currently, the fiscal risk statement prepared under the DBCC is mostly descriptive, so it's a qualitative assessment in its coverage of disaster and climate risk. So what we propose is to quantify and include the contingent liability from disasters, climate change, and other exogenous shocks such as the pandemic to inform the implementation of the government risk layering strategy and support efficient allocation of resources for risk reduction. And to implement this, the government may want to nominate or create a dedicated unit within an existing agency with a fiscal risk management function and mandate to include risks associated with disaster, climate change, and other exogenous shock across government operations, especially on the fiscal outlook, fiscal planning, to incorporate those risks into the current fiscal assessment. And risk financing should also be institutionalized in the proper unit in an oversight agency, for example, DBCC. And this dedicated unit should coordinate overall risk financing activity and formulate annual risk financing plan that set out how the government will finance disaster-related contingent liability as identified in the fiscal risk statement. So I think the main message is to incorporate this risk from natural disaster or other exogenous shock into the fiscal planning process. And then once this is incorporated, to mandate to have the disaster risk financing strategy consistent with the fiscal risk assessment, and to have as much insurance, as much of risk covered by the different instruments that the government has. So that's conclude our presentation. I think we will move to the panelists or commenter from the Congress. Thank you.
Thank you, Ron, Benedict, and Richard. Thank you. As you can see from our chat box, we already have you have triggered questions already from our participants, and I'm glad that some of the questions have been answered by our resource persons, particularly Benedict. We'll tackle some more of the questions during the open forum. Allow me to welcome the presence of Representative Bacnel Lusotan from the Marino Party List. Sir, good morning. Thank you for joining us. Also joining us today are other House officials, Deputy Secretary General, Attorney Giselia Bacani Sipin from the Office of the Speaker, and from the RRB, Executive Director Noel Garong, from the Committee Affairs Department Director Janelena Olyadas. Thank you for joining us this morning. At this point, I am honored to introduce to you our keynote speaker, the Honorable Lucy Marie Torres Gomez. Representative Lucy Torres Gomez represents the 4th District of the province of Leyte. She currently chairs the House Committee on Disaster Resilience. And in this capacity, she advocates policies and programs against climate change, which was spurred by her personal experience during Typhoon Yolanda. She focuses her policy initiatives on disaster prevention through resiliency and climate change adaptation. In the 17th Congress, Representative Lucy Torres Gomez chaired the Committee on Tourism. She successfully led the committee in the Boracay investigations, which eventually led to the historic cleanup of the Boracay Island. In pursuit of her tourism advocacy, she initiated the development of the Tourism Master Plan for the 4th District of Leyte. This is a long-term plan that also integrates considerations of tourism growth, sustainability, and disaster risk resilience. Representative Torres Gomez also was at the forefront of immediate relief efforts in the aftermath of Typhoon Yolanda. She initiated programs and projects for disaster recovery, including those focusing on people's livelihood and rebuilding damaged infrastructure and education facilities. Representative Lucy Torres Gomez is a graduate of the University of the Philippines, and she's happily married to Ormoc City Mayor Richard Gomez, and they're blessed with a lovely daughter, Juliana. For her keynote message, let's hear from Representative Lucy Marie Torres Gomez.
Thank you very much for that introduction, and good morning to everyone. I'd like to thank the Congressional Policy and Budget Research Department for inviting me to share my insights on one of the most crucial aspects of addressing disasters in our country, which is how to finance our disaster fighting efforts. I would also like to thank and congratulate the team from the World Bank responsible for the review report on public expenditure on disaster response and rehabilitation in the Philippines. Indeed, your report illuminates us with a comprehensive assessment of what needs to be improved in financing disaster management in the Philippines. As the whole world takes a pause from normality to tackle the COVID-19 pandemic, other critical issues such as climate change and disaster management just carry on as if everything is business as usual. In these times of uncertainty, there is one thing we can be sure of. There will be no respite from natural disasters. Just recently, Typhoon Bising tore through 5 regions, affecting almost 500,000 citizens, leaving damages of 271 million and resulting in the evacuation of close to 200,000 Filipinos. And it was supposed to be summertime. Indeed, climate change has jumbled up the seasons as well. During the last typhoon season in 2020, the devastation brought in by the last 3 typhoons translated into 41.5 billion pesos in damages and resulted in the evacuation of almost 1 million Filipinos. For years, our country has been ranked in the top 5 most disaster-prone countries. This is nothing new to us now. We firmly understand that the location of the Philippine archipelago in relation to 2 major sources of natural activities, the Pacific Ring of Fire and the West Pacific Ocean, deliver a double whammy of geologic and climatic vulnerabilities. This high disaster vulnerability situation is nothing new. Our location has not changed for many millennia, so storms, typhoons, heavy rains, and earthquakes have been occurring for ages. However, what changed is the presence of human settlements and the rise of human-induced climate change. Therefore, natural phenomena only become disasters when they hurt humans, environment, and property. I strongly feel the need to reiterate and emphasize this narrative because it is essential in understanding the importance of disaster resilience. Disaster resilience is then the ability of communities and the nations as a whole to adapt and recover faster from disasters. Therefore, following the narrative, disaster resilience has a lot to do with efforts in protecting human, property, and environment from the destructive forces of natural phenomenon such as storms and earthquakes. The World Bank Review report indicates that in 2018, total disaster-related appropriations amounted to 104 billion, representing 3.6% of the year's total GAA figure. This amount was the sum total of various items, including the NDRRMF, or the National Disaster Risk Reduction and Management Fund, the QRF, or the Quick Response Fund, agency-specific disaster program funds, among others. Disaster financing is intended to support programs and projects along the four main pillars of disaster development. 1, disaster prevention. 2, preparedness. 3, response. 4, recovery and rehabilitation. The first two pillars deal with activities before disasters hit, and the last two deal with the activities after disasters hit. Disaster resilience is developed by engaging in the first two, disaster prevention and disaster preparedness. There are 2 points in the report that I would like to dwell on, specifically because these affirm our country's need for a Department of Disaster Resilience. The first one is the lack of prioritization for disaster resilience. Second is fragmented funding, which means fragmented programs and projects. Let's first expound on the first point. The World Bank report's latest data confirmed that out of all the public funds intended for disaster spending, only a negligible amount went to pre-disaster resilience and adaptation building programs and projects. If we are wondering why we are not moving any closer to becoming a disaster resilient country, this is one of the major reasons. We are simply not investing in developing our ability to adapt to disasters and be resilient enough to reduce the impact of climatic and geologic natural events on the Filipino people, properties, businesses, industries, communities, and our environment. As the wise proverb goes, an ounce of prevention is worth a pound of cure. This does not resonate any stronger than on the subject of disaster resilience. There is no doubt that we need to respond to disasters and rehabilitate devastated communities, but focusing solely on these programs and projects will not result in reducing the impact of storms, volcanic eruptions, earthquakes, droughts, and floods. We already know that the occurrence of these destructive natural phenomena is really not in our control. So let's focus on what is controllable by our actions and programs. And what we can control is how we equip ourselves with infrastructure and systems to reduce overall destruction and losses. I consider disaster resilience programs and projects to be more value for money because they are more effective in reducing long-term disaster funding requirements. Moreover, at the end of the day, it is not only about money. There is no amount of money that can compensate for human suffering and loss. Even at the economic level, there is so much stress created by a repeated cyclical pattern of building, destruction, and rebuilding. Disasters hinder our country's path to economic growth. Last March, the House of Representatives, through the efforts of the Committee on Disaster Resilience, approved on third reading House Bill number 8990, or an act establishing evacuation centers in every city and municipality and appropriating funds therefore. This is perhaps the most immediate immediate and urgent disaster resilience project for the country today. The bill calls for the establishment of standardized evacuation centers that can provide the basic amenities and capacity required to take decent care for evacuating families. This project demands a huge capital expenditure totaling 40 billion, taking into account about 1,600 LGUs and a standardized evacuation center costing an average of 25 million each. This amount seems huge, but we need to remember that this is the same amount of the damages from the last quarter of 2020. The second point is that fragmented funding means fragmented programs and projects. Although this was not considered a primary report finding, the observant reader could discern the obvious, that the funds are distributed to so many agencies, which makes coordination and integrated action impossible. This situation underlines the deficits in coordination, organization, integration, accountability, and leadership that continue to influence and define how disaster management operates today. It is high time for government to pivot towards a more centralized approach to addressing disaster management in the country. We cannot afford to continue this fragmentation approach. Last September 2020, the House passed and transmitted to the Senate the creation of a Department of Disaster Resilience, which will consolidate the key existing agencies, namely the disaster-related functions, assets, personnel, and funds of the Office of Civil Defense, presently under the DND, the Disaster Response Assistance and Management Bureau, and the National Resource and Logistics Management Bureau, both presently under the DSWD, and the Program Management Office for the Earthquake Resiliency of the Greater Metro Manila area. The DDR's mandate will encompass an expanded set of PAGASA and FIVOLTs of the DOST, Geohazard Assessment and Engineering Section of the MGB and the DNR, of the DNR, Health Emergency Management Bureau of the DOH, Bureau of Fire Protection of the DILG. This direction towards integration would also imply a shift to integrating financing mechanism for disaster-related programs and projects. This would greatly benefit the entire disaster management system by removing inefficiencies in processing, funding, duplication of efforts, and promoting project accountability. Establishing this integrated approach encourages a holistic problem-solving perspective, which is fundamental to finding disaster resilient solutions. These solutions cannot wait, because disasters occur whether or not there is a pandemic. I urge our legislators in the Senate to expedite the passing of their counterpart bill. Most importantly, having the DDR in place ensures that whatever economic recovery we achieve would not be at risk of slipping back just because of disaster events. Thank you very much.
To provide more government perspective in our discussion, we have invited discussants who are familiar with how government has been budgeting and spending for disaster response and recovery. Our first discussant is from the Department of Budget and Management, in the person of Director Cristina Clasara. Director Clasara is currently the Director of the Budget and Management Bureau of the DBM that handles the National Disaster Risk Reduction and Management Fund, or the NDRRMF. She is an expert in the field of government budgeting, having served the DBM for almost 4 decades. Director Clasara is a certified public accountant and holds a master's degree in accountancy from the University of Wollongong, New South Wales, Australia. Our second discussant is from the Commission on Audit, Director Michael Bacani. Director Bacani is a certified public accountant and has been with the Commission on Audit for the past 38 years, also almost 4 decades. He has been assigned to different agencies as audit team leader as well as supervising auditor. He was one of the country's United Nations auditor who audited different UN agencies abroad, such as the Food and Agriculture Organization, or the FAO, the UN High Commissioner for Refugees, and the UN headquarters in New York. Just last year, after a three-year stint as regional director of the COA regional office in San Fernando City, La Union, he became the director of the Defense and Security Cluster of the national government sector. And we're glad that he has joined us today to share some findings from the audit of the NDRRMF. Now let's hear from our first discussant, Director Clasara, to be followed by Director Bacani. Director Clasara, you have the floor.
Thank you, Pamela. But first, let me thank also the World Bank, particularly Ron, Benedict, and Richard. For the first time, I understand that the public expenditure review on disaster response and rehabilitation in the country was done. This is the first one. So now allow me to provide insights on some key messages on the published PER, particularly in its findings that post-disaster spending could be made more timely, transparent, and more efficient. One of the recommendations mentioned is to ensure that adequate funding is available for immediate post-disaster needs by revising the quick response funds allocations to ensure adequate funding and minimize the need for replenishments. Slide, please. Thank you. For the past 10 years, agencies' QRF allocations have substantially increased from a mere $2.95 billion in 2012 to as high as $7.6 billion in 2018. You may also note that in 2012, only DSWD, DND, and DPWH were given QRF lodged in their own budget. However, through the years, other agencies such as the Department of Agriculture, Department of Health, Department of Education, NEA, NIA, were likewise been given QRF to respond to the need of times. Let me point out that the QRFs of DSWD and DPWH doubled in 2015 and DA in 2018, as these agencies often requested for replenishment. Yes, I agree with the World Bank that there is a need to revisit QRF allocations based on past expenditure data, among others, as these have more or less remained constant since the increase in 2018 to avoid frequent requests for replenishment, which would cause additional administrative costs. Second is to strengthen the NDRIM fund by streamlining procedures and revising the design and operations, as the delays cause the effectiveness of the NDRIM fund in achieving its purpose. On this, we totally agree. At present, proposals are being evaluated by the National Disaster Risk Reduction and Management Council. Then it goes to the Office of the President for approval, and finally to the DBM for fund release. This process is provided under Section 22 of RA 10121. However, while the law is clear as to the recommending agency, approving agency, and releasing agency as mentioned, the approval process may still be streamlined by reducing the number of steps, documentary requirements, and signatories as mentioned in the PER. But first, let me show the annual NDRIM fund provision. Next slide, please. Similar to quick response fund allocation, annual allocations under the NDRIM fund vary on the established needs, among others. However, we acknowledge that there is a delay actually in the release, as well in the use of funds by the implementing agencies. A case in point is the $5 billion allocation for the comprehensive aid to repair earthquake damage, or the CARE, for which an issue was raised by the House as well as in the Senate. The amount was intended to cover the needs for the earthquake that occurred in the last quarter of 2019. In 2020, out of the $5 billion that was allocated in CARE, only a mere $312 million was released as of December 31, 2020. Luckily, the validity of the appropriations was extended until 2021, this year. Otherwise, the $4.7 billion could have gone to waste. We are almost in the middle of the year 2021, and to date, only 1.8 billion have been released, leaving still a balance, a substantial balance of 2.9 billion as of May 31. At present, the OCD is revising the guidelines in the administration of funds in order to streamline the process on the release of the NREAM fund. We really agree, we really have to rethink and update the damage approval and funding request process. Maybe we can look, maybe in NREAM-C, we can look at the process adopted in the release of the 4.5 billion funds lodged under the Local Government Support Fund, Disaster Rehabilitation and Reconstruction Assistance Program for LGUs under the 2021 GAA. These funds were swiftly released by the end of January 2021, allocated among affected LGUs based on NREAM-C situational reports as to damages and based on DSWD's report on the number of affected population. In a like manner, based on certain criteria and parameters, a formula may be developed to allocate funds among sectors or departments as a trigger for the release from the NREAM fund instead of the usual agency submitting a proposal, NREAM-C to evaluate, and then goes to OP. The process is really, really long. And as mentioned, speed matters. We concur also with the statement that we should focus our limited funds in the NREAM fund on post-disaster activities. Regular risk reduction and management should be funded through planned regular budgets under the public investment process. Actually, we are currently observing this one. The regular risk reduction and management programs and projects are already lodged in agency budget. For instance, the construction of evacuation centers are in the, that was mentioned earlier by Congresswoman Lucy Torres Gomez, is lodged in the budget of DPWH. Provision of scientific equipments to the ST Pag-asa for a more accurate and timely weather forecast, DPWH and MMDA for flood control projects, etc. The crop insurance under the Department of Agriculture. For the insurance of government assets, this was initially budgeted in the NREAM fund for years 2017 and 2018. Eventually, for 2019 and 2020, the budget was provided in the Bureau of the Treasury. However, under the 2021 budget, an amount of 2 billion for payment of insurance premium was again lodged under the NREAM fund. So we hope we could refrain from tapping the NREAM fund for this type of expenditure, rather focus the NREAM fund on post-disaster activities. On the reporting of disaster-related expenditures, these are indeed fragmented. The tracking and actually consolidation proves to be challenging. While we in the DBM post in our website the status of releases from the NREAM fund for various calamities, each implementing agencies, on the other hand, submit to the DBM and COA reports on fund utilization and project implementation. Although consolidated reporting platform was attempted for Typhoon Yolanda, it did not succeed in attaining its objective. There is no single agency that puts together this information, which is vital for information decision making. LGU have also their own methodology of tracking disaster and related expenditures, and I'm not sure if the DOF through the Bureau of Local Government Finance is monitoring this one. It is a good idea to explore the expansion of the climate change tagging to capture the DRR tagging as well through the AD-based technical assistance under the Disaster Resilience Improvement Program. It was also mentioned that even if all disaster-related spending are accurately tracked, unless there is clarity on actual damages incurred, the government cannot evaluate if spending and outcomes are sufficient to protect the population, the economy, and the government property. Again, this is quite true. And this gap is acknowledged with the issuance of Administrative Order Number 4 in 2018, creating an interagency committee on government property insurance. This interagency committee found that the majority of the strategically government properties are either underinsured or not insured at all. We also thank the World Bank again for commissioning a study by the PricewaterhouseCoopers on asset registry, which revealed that there's no single agency handling asset management and registry. This led to the establishment of the National Asset Registry under the BTR to record inventory and national government assets and issuance of the Philippine Government Assets Management Policy in September of 2020. Yes, we can take off from these implementing reforms to improve disaster damage and loss assessment and recording. So let me end by stating that most of those identified gaps in the PER reinforces the need for the creation of the Department of Disaster Resilience, which the executive branch fully supports. With that, magandang umaga po and mabuhay.
Thank you, Director Clasara. Now let's hear from Director Bacani from the Commission on Audit.
Thank you, Pamela. Good morning, everyone. The Commission on Audit, as the country's supreme audit institution, under Section 2, Article 90 of the Philippine Constitution, plays a significant role in the public sector governance. This mandate gives COA the responsibility to ensure accountability for public resources, become part in the development of a sound financial management, examine proper execution of administrative activities, provide information to public authorities and the general public through the publication of objective reports, promotes transparency, and help improve government operations in partnership with stakeholders for the benefit of the Filipino people. The Commission does 3 types of audit. Well, it also includes the audit of the DRRM funds. Those 3 audit streams are the following. 1, financial audit, 2, compliance audit, and 3, the performance audit. In the conduct of financial and compliance audits, in the audit of the DRRM funds, the auditors are guided by COA Memorandum Number 2014-009, dated August 28, 2014, which is aptly entitled Guidelines in the Audit DRRM Funds. In said memorandum, the auditors are instructed on what to look into and how to conduct the audit of the funds. In the conduct of performance audit, the auditors are guided by specialized manual on disaster risk reduction management, which incidentally, the manual, coming up of the manual, it was funded by the World Bank itself. The performance audit manual was issued in January of 2016. So the 3 audit streams, financial audit, compliance audit, and performance audit. As I had mentioned earlier, the COA provides information to public authorities and the general public through the publication of objective reports. If you would visit the COA website, you could find there the DRRM reports already issued by the Commission on Audit. The most common of which is the consolidated report on the audit of DRRM for the year ended 2014 to 2019. The report is issued yearly, and what you can see there are only financial and compliance audit. There is no exclusion there of the performance audit done by the auditor. The Commission on Audit has an office primarily tasked to do performance audit. So I would say that the performance audit is special audit, which deals in the audit of the programs, project, and activities of government offices. Such may include the audit of LGU as well. Okay. In compliance with the COA Memo 2014-009, or the issuance of the consolidated report on the audit of DRRM funds, the reports are merely consolidation by the OCD auditor, which were to be transmitted on or before August 30 of each year, which means that these findings are called from the annual audit reports of different agencies, national government agencies, government-owned and controlled corporations, as well as those of the local government units. So in that report, you can see the authority or the objectives of the audit, the financial and operational highlights, the summary of significant audit observations, the status of implementation of prior year's recommendations, acknowledgement, and the annexes. For the performance audit reports, we have already issued 4. Although these reports were done in 2014 yet. The report includes the management letter on the project, disaster and awareness and preparedness information material and tools development, dissemination, specifically on DRR capacity building and DRR communications for CY 2016 to 2017. Actually, this is the report on the performance audit of fieldworks, Philippine volcanology. And we also had a performance audit report on the implementation of the geohazard mapping and assessment program for calendar years 2013 to 2015. The 2014 report on the audit of typhoon Miranda relief operations. And lastly, the 2014 assessment of disaster risk reduction and management of the local level. So what were the results of the audit? What I'm going to present to you this morning are the consolidated findings on the 2019 report that was issued by COA. I noticed in my research that these findings have been recurring since 2014. So I would say that we may not have things that improve, no improvement so far. So with the plan of the Congress to come up with the Department of Resiliency, I think it's the best solution for us to have a dedicated office and a dedicated auditor to audit these DRRN funds. These are the results of the audit. Now, for national government agencies, for year 2019, there were 16 NGAs that have been given NDRRN funds, or appropriations were made to them. One of the findings for national government agencies is the unutilized DRRN funds. This happened in the SWB CAR. The second finding is the utilization of NDRRN fund are not consistent with its intended purpose. This happened in the SWB Field Office number 5, wherein the fund was used in paying salaries and wages of non-permanent employees and other activities that are not disaster risk management related. So there was the use of fund not intended for the purpose. Another one is the non-utilization of QRF. This is a finding in the GHQ, General Headquarters of the Armed Forces of the Philippines, wherein the 750 million pesos QRF fund remained unutilized. Also, we have a finding on the low utilization of QRF. I'm disturbed with this finding. This finding was called from the annual audit report of the Office of the Civil Defense, wherein the amount of 500 million was utilized, the utilization was not maximized. And also the delayed delivery of food items procured out of the QRF. This is also a finding, an observation in the Office of the Civil Defense, wherein delivery of family packs intended for the victims of disaster calamities, which were procured out of the QRF of the OCD, was not made because the money was lodged in the PITC, or the Philippine International Trading Corporation. The amount of transferred fund totaled 458.15 million pesos as of December 2019, which should have been procured for family packs during the years 2015 to 2018. So this is quite a disturbing observation. Also, another observation is the unliquidated Marawi and Yolanda funds. This is also with the General Headquarters of the Armed Forces of the Philippines, wherein financial assistance to the victims of Typhoon Yolanda and the Marawi seeds amounting to 679,822 and 65,845 respectively remained unliquidated as of year end. Also, there was an unremitted Marawi funds from the Armed Forces of the Philippines Health Services Center, where the amount of 480,000 was not yet returned to GHQ, to the General Headquarters. The fund remained unused, so it should have been remitted to the headquarters of the AFP. This finding again, the next finding is a recurring one, the non-submission of reports and non-disclosure of reports of information to the public. Requirements on the utilization of DRRM and the QR fund amounting to 432.77 million for CY 2019 were not strictly followed by the Department of Agriculture. So those were the findings for the national government agencies on the report on the consolidated 2019 report. Now for our government-owned or controlled corporations, during 2019, 4 GOCCs were issued or were given NDRRM funds. These were the LUWA, the NEA, NIA, and the Social Housing Finance Corporation. There was only one observation for GOCC. It actually pertains to LUWA, the Local Water Utilities Administration. It was mentioned in a report that there was a lack of policy and procedures in the implementation and monitoring of the Yolanda funds. That amount total 371 million. Okay, for local government units, we have an observation on the undistributed and unutilized commodities procured out of TRF. This happened in the city of Bacolod, wherein the amount of larvicides and insecticides and test kits, which were already procured, have not been distributed to the people. So, the control of dengue epidemic may not be attained and may expose the supplies to risk of possible loss or misuse. Okay, that's one observation. Another one is the improper charging of disbursements. The amount of 318,257,667 on the funds of 110 LGUs were utilized for the purpose other than the RRM. It's similar to that of the finding in the national government agencies wherein the amounts were paid for the salaries of employees, and that activity is not related to disaster risk and reduction management. Also, there was a failure to transfer of the unexpended LDRR and F balances to special trust fund. Because in LGUs, the trust fund only should only compose of those funds within the 5-year period. So if ever the funds were not utilized on the 6th year, the fund that would move to the 6th year will have to be returned to the general fund. Okay. And there was also underutilization of the local disaster risk reduction and management fund. In our report, there were 55 LGUs who did not optimally utilize the allotment under LDRRMF. So if you would read the report, you can see in Annex E of the report which LGUs, which of those LGUs have not utilized their allotment. There was also a low implementation rate of PDR and plans. Again, non-submission of reports, 219 LGUs. They did not submit the monthly report on the receipt and utilizations of DRRMF sourced from GAA and past donations and other reports as well. Also, the non-creation of LDRRMO in LGUs. Non-disclosure of reports, information to the public. Again, non-reversion to the general fund of the unutilized balances. Some funds were utilized without the necessary revised or supplemental annual investment plan. And of course, there were also accounting deficiencies. So in all those observations actually coincide with what Benedict has said a while ago. There is really a need to improve the reporting standards as well as compliance, not only by national government agencies and GOCCs, but most especially for the LGUs. COA has been doing its best, but again, we only have limited personnel, and having a department which would basically concentrate on doing the DRRM. So I think our auditor at DRRM would actually be more comfortable doing the audit of the funds. Thank you very much.
Thank you, Director Clasara and Director Bacani. From the findings, the audit findings shared by Director Bacani, I noted three observations: underutilization of the NDRRMF fund, which was also, I think, highlighted in the public expenditure review; non-submission of reports. So that's why I think also the World Bank noted that we have incomplete data, so we cannot really get a complete picture of how much we are spending for disaster response and recovery. And another finding is the use of funds for non-disaster purposes. Okay. Now, we will go to the open forum to entertain your questions. So some of the questions posted in the chat box have been responded to. Thank you to our resource persons who have been answering them. So let me go to the other questions that have remained unanswered. Okay? And if you wish to raise your questions in person, please use the raise hand function so we can acknowledge you. So here's a question from Director Jana Oliadas. So in the discussion of Bayanihan 3, there were concerns raised in more funds and power being given to local government units, and that it would be better to give this to departments as they can be subjected to oversight by Congress. In this regard, how can the World Bank assist in strengthening the financial management and reporting capacity of LGUs? Be anyone from the World Bank team can answer this?
Thank you. Actually, see if Rong is still connected. I know it's late for her in DC, but she has been most closely involved in the discussion around the helping support related to Mandana's ruling and decentralization.
Hello?
Yes, Rong, we can hear you.
Yes, maybe I can try. Yes, I think there was quite some discussion whether the national government agency implement or provide some of the support versus the LGU. I think there's pros and cons in both approach. The LGU approach is that they know the constituency better, and given the lack of national ID, I think for the national government to disperse and provide the support very quickly is continue to be a challenge. And thankfully the field sys registration is quite advanced, so hopefully that this year can reach to our substantial number, and that can be used for future disbursement of social protection measures. But currently it's still the LGU that is doing the disbursement. What the national government can do to strengthen and to also to facilitate the disbursement is to use really more the digital payment system that is available. We know that many people don't have a bank account, so that through the banking system might not work, but most of the Filipino has a cell phone and they are subscribed to GCash or PayMaya, and there is a requirement to verify their identity. So that is a compromise or a not perfect approach, but in the interim that could serve to provide quick release of social protection support, for example, while also have a way of monitor, evaluate, and also to just to verify that the beneficiary received the fund. And that can be done in collaboration with between the LGU and the national government agencies. I think given the lack of existing mechanism to provide support rapidly to the households, working with the LGU is useful, but they have to work very closely to ensure that the funds reach to the citizen, and there's a mechanism for verification. Over.
Thank you, Rong. There's a question here from Director Pasagi on the low insurance penetration among LGUs, and that the Philippine Development Plan lists mandatory property insurance among the priority legislation. And with the implementation of the Supreme Court ruling on the Mandanas case, which transfers more resources through the ERA to LGUs, the question here is, can property insurance be now made mandatory for LGUs as a safeguard against catastrophic shocks? Maybe we can hear from the World Bank or even from the DBM. This is removing funds from the national government and really downloading it to the local governments. So can we now make property insurance mandatory for our local government units? What do you think about this proposal?
Maybe I can have a first response. And so my understanding is that in fact it is already mandatory up to first-class municipality and LGUs. However, the problem has been much more in compliance and the quality, both the amount of insurance and the quality of insurance. So I think big parts around this are both around the implementation, operational implementation on sufficient premium for LGUs, which might be less of a constraint now with the increased IRA, but then also the quality of insurance that LGUs can access. And this is something which colleague from DBM has mentioned through the AO4 in 2018, this larger program which is under development, the National Indemnity Insurance Program for government agencies, which may also help GSAS provide the sufficient service to LGUs over time to help fix the supply side in a way. But equally, of course, it requires sufficient compliance by LGUs to actually purchase the insurance. So to me, it's my initial reaction would be that's probably more of a problem of implementation, what is already there. How much further to go in terms of making compulsory, of course, becomes then also a political question, and then a question of the relation between national government and LGUs.
Yeah, thank you. Actually, there's a House bill pending in Congress, filed by Congressman Salceda on LGU Property Insurance Act. Yes, what Benedict said is true, is right. There's now insurance for first-class municipalities are mandatory. So this House bill proposes coverage for all, for So all municipalities, not only the first-class municipalities. And hopefully we can have a better inventory of the local assets. As far as we know, as the properties insured by local governments with the GSIS are more like motor vehicles and less of the, like the buildings and land improvements. So hopefully we can improve on coverage of insurance for local government units. Here's one question. LGUs tend to be dependent on national government, especially when large disasters strike, even if they still have remaining balances on their local DRRMFs. What kind of cost sharing rules between national government and LGUs are needed to ascertain which costs the NG and the LGUs are responsible for? Maybe anyone from the World Bank or from Director Clasara?
I can say something from the World Bank, but I think the perspective from DBM, of course, will be critical here as well.
Yes.
And I mean, looking also at the experience of some other countries, now I'd say it's important that there is no single correct decision, right? What LGUs would finance, what the national government would finance. It's a decision that has to be worked out in each country, case by case. But what is important is that there is a clear decision up front, and having clarity helps both in improving the risk, what we call risk ownership, that local governments know what they're expected to pay for. As long as there's a lack of clarity, LGUs or any subnational governments anywhere else in the world always have the option of wait and see, because they may receive additional support. And it also reduces incentives for risk reduction and just general planning. Now, as different governments have taken different approaches. One example in case of Mexico, where the cost sharing was really focused on infrastructure recovery costs. And there, it's very clear up front, the national government will pay 50% of the cost for rehabilitation, reconstruction of infrastructure owned at the subnational level, and the local government is expected to pay 50%. Now, it doesn't always work as clean in practice, and often local governments still struggle with these resources, but at least the principle is clear. Other cases like Australia, it's much more of an aggregate cost sharing, that once local governments, states have paid a certain amount of, incurred a certain amount of aggregate damage, the national government will pick up parts of the cost sharing. So there's different formulas. We can share more examples with you as well, and as background resources. And I think that it's important that this is being worked out collaboratively between the national government, the legislative branch, the executive branch, and also representatives of LGUs. What is the most efficient approach? But what would be a huge step, I think, towards increased efficiency is to start putting rules down. Even if it starts simple measures and gradually becomes more refined over time, I think it would be a very important measure.
Thank you, Benedict. There's a question here for Director Clasara. The question, ma'am, is are replenishments or maybe augmentations not standardized as to frequency in order to avoid unprogrammed replenishment, or maybe we need reallocations, unprogrammed budget requests that increase the admin cost, as you have earlier mentioned?
No, there is a rule on augmentate if you're talking of the replenishment of the quick response fund.
Yes,
when
yes,
the QRF, it is stated in the general provision that the agency, once it reaches a critical level, or at least 50% of its QRF had been utilized, they can go to the DBM. They can go to the DBM and request for replenishment. That's the rule. So if you're referring to the QRF, when it reaches 50%, you go to the DBM and release. And normally it is processed within 3 days. The replenishment is very and release of the QRF is very quick. It doesn't go to so much processes. It just go to the DBM decides and release.
Thank you, ma'am. There's a question here in the chat box from Director Rosemary Sagwali. One of the recommendations mentioned is having a prearranged finance in place to help ensure that actions are taken more quickly and decisively to reduce overall health and economic impacts. So Director Sawali is asking how this mechanism works. How can this be funded from the budget given very limited resources and many conflicting demands? Is it like a standby loan facility? Or so are there countries which have already this pre-arranged financing in place? What are some of the features which the Philippines can probably consider in looking into this mechanism? I don't know who can answer this. Richard, maybe? Richard?
Yeah, sure.
Yes, thank you.
So when we talk about pre-arranged financing, it's not necessarily one single financial instrument. All we are talking about is a financial instrument which is arranged before a disaster occurs. And in the case of the Philippines, you're actually using multiple instruments that work in this way already. So the NDRRM fund, for example, can be considered pre-arranged. It's financed from the national budget, but it's not arranged after a disaster. It's arranged as part of the national budget cycle. And the QRF component of that is intended to be available such that spending can occur immediately after a disaster event. In the past, the Philippines have also used these standby lines of credit that you mentioned. So, for example, there was a program with the World Bank where there was a standby loan facility which was arranged in advance, and then upon the declaration of a calamity, the government has access to that finance very quickly. So that's another example of a pre-arranged financing mechanism, and the Philippines have already utilized this in the past. There are other examples too, such as risk transfer. For example, the catastrophe bond that was placed in 2019 and the insurance programs that came before that also were designed to provide finance very quickly after a disaster event, but they were arranged beforehand. So all of these different instruments would be considered pre-arranged financing. And there are many countries around the world that utilize these, and the Philippines has used these mechanisms as well. And so I think the key message here is that actually most of the pieces are already there for the Philippines. It's the challenge really is the consolidation of all of those different sources and ensuring that they are appropriate for the priorities of the government, the expected expenditures from different kinds of disaster events, and to ensure that these different instruments work together so that you have a cost-effective system in place. So it's not necessarily about, for the Philippines, it's not necessarily about putting in place more financial instruments that operate in this way. It's more around ensuring that they work together effectively, the existing mechanisms, and then ensure that you have efficient systems in place such that when a disaster does occur, finance can reach the impacted people or businesses or LGUs, whatever the target beneficiaries, whoever the target beneficiaries are, ensure that finance reaches them quickly and cost effectively.
Thank you, Richard. Let me direct this question to Director Bacani and Director Clasara. When disasters, especially the large-scale calamities and disasters strike the country, there's usually a lot of donations and disaster assistance coming in. So I was just wondering how the government actually accounts for donations. What the public expenditure review covered are like the allocations that form part of our national budget. So, but during the year, when calamities strike, donations come in. So, what, how does the government, account for this? Because I feel that this is very important that we are able to get a good picture also of the donations, especially when we need to target our disaster assistance with very limited funds at the national government level. So I don't know if COA has some kind of accounting also for for donations. I remember Director Clasara mentioned about an effort to make an accounting of the Yolanda funds. But is there something more institutionalized to actually account for donations?
Yes. I'm sure that the COA director there is privy on the accounting of the donation. Donations are considered automatic appropriations, particularly if donations is forced through the national government. Remember that there are some donations that goes direct to the beneficiary. But let us talk to the donations that goes to the coffers of the national treasury. It is being accounted as a donation, as an income, and then it is automatically appropriated. At present, I understand that the OCD has that consolidates that report on donations, and it's the OCD that decides also on how these donations will be disbursed. So on top of the funds under the NDREAM fund, they have also in their coffers the donations. It is an automatically appropriated, and if it goes to the national treasury, it is accounted for. And so likewise being audited.
Yes, that's right, Cristina. First of all, we're looking for the deed of donation. Actually, when an agency, a local government unit or a national government agency, or even a GOCC, when they receive donations, first and foremost, there should be a deed of donation, because an entity that just give you a fire truck and then that's it. So the agency could also know how much to book up for that donation, how much is the value of that donation. Now, if those donations are unvalued, management should appraise the value of those donations so that everything has to be accounted for and has to be booked up in the books of accounts of the agency. In the case of OCD, for 2020, there were lots of donations which remained unbooked. That's why it was an audit observation of our auditor at OCD.
Thank you. Let me read a question from the chat box. Can you think of a country example of an effective disaster financing mechanism covering pandemics and other exogenous shocks, and share key points on how the system was mobilized at the onset of a major public health crisis? What are the key features of the system, and does it deviate from usual considerations when developing disaster financing mechanisms for natural disasters? How might the COVID-19 pandemic enrich the discussion on disaster risk and response financing, especially in the Philippines, as it relates to strengthening health systems and building responsive social protection systems? Anyone, maybe from the World Bank? Is this for Richard?
Richard, you want to start?
Why don't you start, Benedict? That's a hard question.
It's a hard
There
question.
are several questions here. Yeah.
Yeah, there are several questions.
I think it's a very good question, and of course the key of this is to see what has worked well, what can we all learn collectively around the world, and what can we improve to be better in the future. And hopefully we won't face another pandemic of the severity like COVID anytime soon or at all, but even for smaller shocks, like what can be learned. And I think as a starting point is, I think it's fair to say that no country was prepared for COVID. And frankly, we would not expect any country to be prepared for something like COVID to that extent, right? So every country had to experiment and learn and prepare response as we go along. Nonetheless, of course, countries have been able to draw on mechanisms, financial preparedness mechanisms that already exist, and build on those and leverage on those. So one example that is worth mentioning, one financial instrument, is the World Bank's CAT DDO, which is a contingent line of credit by the World Bank. Richard has mentioned it briefly, as the Philippines has also availed of this in the past from the World Bank. At the moment, there's no contingent of credit between the Philippines and the World Bank, but I understand the government has other such arrangements with ADB and JICA. But the reason it's an important example is the World Bank CAT DDO has eligible triggers to disperse against natural disasters, but also disperse against pandemics. And in fact, most of the funding that the World Bank was able to release to support countries, the fastest funding came from those lines of credit to countries around the world. So what the lesson we can learn from this is that it's the integration of different type of shocks into financial mechanisms, into financial plannings, because just the way that COVID was an unexpected exogenous shock to that magnitude, there might be something else coming in the future, and it is hard or impossible to prepare for every single potential shock with individual mechanisms, with individual plans. But what we can do is to see how we can make mechanisms, plannings, instrument shock agnostic in a way, to allow mechanisms to respond to different shocks that may occur. So whether this is the CATDO with the World Bank, whether this is to allow the National Disaster Risk Reduction Management Fund to be able to respond to different type of shocks that may occur, right? So I think the integration of comprehensive risk planning, taking a comprehensive view of what risks might occur and allowing structures to be multi-use, shock agnostic in a way, is a very important starting point. The second point, sorry, I forgot this now.
I think to add from what Benedict has said, so I completely agree with the fact that COVID, of course, was a shock that was beyond what any country had really considered from a health crisis point of view, and in particular its knock-on effects for the economy and businesses. But in terms of learnings from it, I think I would come back to the main principles of disaster risk finance, and in particular in terms of risk assessment, being able to use the information and knowledge that we do have to put in place plans for these kinds of events in the future. And so there's obviously, since COVID, been a lot more thinking done around the potential future risk of pandemics. And I think that now needs to be considered alongside the knowledge and information that we have with regards to natural disaster risks as well. And then it's only the combination of these things that allows us to then plan for them financially. And then as part of that strategy that we put in place to finance the response to these kinds of events, another principle that I would draw on is this idea that we need a variety of different financial instruments to be able to address all these different kinds of risks and to support different stakeholders who are affected by those risks. So I would consider the fact, so as Benedict mentioned, there are some instruments which would apply to any kind of disaster event, and those instruments, such as the contingent financing that Benedict was mentioning, we're able to draw on those instruments for any kind of disaster events. There are other instruments which are specific to certain hazards, for example, insurance against typhoons. And I think it's still the case that the Philippines would look at its principal risks as still being typhoons, earthquakes, and then now potentially health crisis like we've seen with COVID. And so in terms of addressing or learning from that and how that impacts our planning for the future, it's a case of understanding the potential risk and then developing or utilizing different kinds of financial instruments which allow us to finance both health crises but also natural disaster risk, which of course has not gone away just because of COVID. It's very much there, and as Rong mentioned right at the beginning of our presentation, that that's really a principal source of risk right now to the Philippines' ability to bounce back from COVID quickly.
Can I just add one additional point to this? I think that's the experience of building on everything the government has done over the last 12 months, right? And to see what mechanisms have worked well and maybe useful to institutionalize going forward. So whether it's work with Dole for unemployment assistance, or whether it's work with DSWD to institutionalize better and scale up social protections mechanism and safety nets, so that those same mechanisms can actually be available in the future to serve as disbursement channels, as reaching the vulnerable population quickly, and don't have to be recreated for a different shock of another shock, so that they can become contingent systems. The same way we talk about contingent prearranged financing, we have the prearranged contingent systems to reach populations and to build on all the work that was carried out over the last 12 months already. Thank you.
Yeah, thank you, Benedict and Richard. Allow me to just have two more questions. I know we're going over time already, and my apologies for not being able to serve you lunch since we are online. Yeah, but thank you for staying on, and to all our participants who are still with us. Um, I will throw a last question and maybe ask for a very brief answer from all our resource persons, and you can think about, like what key policy or budgetary reforms you can or think of, and that we should include in the legislative and oversight agenda of Congress, whether it's, like how we can further improve on um, reporting, improving on our utilization of uh, the disaster funds, um, proposals maybe on, on institutionalizing disaster risk financing. Okay? But just one question before that. One recommendation earlier mentioned, I think by Rong, was to include disaster in the fiscal risk assessment and planning. And so far we have included, but they are qualitative. So we need to, data and information to quantify them. And um, Representative Lucy Torres Gomez mentioned earlier about the House bill that was passed a third reading here in Congress, in the House of Representatives, and it's already transmitted to the Senate, which was the creation of the Department of Disaster Resilience. And one provision in that bill is actually the establishment of a database to include not only, like the inventory of hazards. So I was wondering if you can just give us, like ideas, what kind of information or data we need to have in that database, so we can effectively, like make this, include disaster in this fiscal risk assessment and planning.
Rong, are you still connected?
Yes, should I start? I think that summarized my main point. It's really to integrate the disaster risk financing consideration in the fiscal planning, because this is not a real event. It actually occurs every year. So we need to factor in the associated costs beforehand, so the government can allocate an adequate amount of budget for post-disaster response. And for this seminar, obviously, is to prepare well in terms of the financial instrument that can protect the country to have the resources to respond. And from other studies, I think the government can streamline some of the processes so the funds can be dispersed faster for reconstruction effort. And finally, to improve the monitoring and data collection, so this strategy can be reassessed regularly to improve. So I stop here. Thank you.
Maybe I can add something specifically on the data requirements, right, to assess to assess fiscal risk, which ultimately look at fiscal risk from disasters. You look at both expenditure and revenue risks, so but often driven from contingent liabilities to the government budget expenses the government may incur or will incur when a disaster happens, but are not fully set out in advance. And I think the key data sets for that are threefold. One is the assets the government owns, knowing what is in harm's way. The disaster risks, so the scientific and hazard information, for example, collected by DOST, as well as internationally, to build risk models. And right, then you can combine these two and start estimating what is the actual loss and impact to the government. Now, part of that comes from damage to assets, physical assets. Part of that, of course, comes from social support, social spending, whether it's to households or to SMEs, to the real economy. So looking at this gives you a measure of modeling, of assessing the risk, forward-looking, what might occur, and putting a number to this. And this is essentially what insurance companies are doing to price risk into the future. So this is quite sophisticated. by now, and this can be rolled out as long as you have the measures of what assets exist, what value is at risk, what is the potential impact from disaster, what disasters do you face, and then of course, what does the government pay for, right? Not everything that gets damaged for a disaster, the government pays for. If it's private assets damaged, the government often does not pay for it. So it's not a contingent paid to the government, but it's still an economic impact. And the third, I think, important data set to collect is accurate historical damages and losses. Because while forward-looking modeling can be important, can also be quite technically complicated, but the best starting point is just understanding how much has been spent every year in the past, both because this gives the government a good sense of how much it's spending for and how much is it covering of damages incurred, but also because because it both gives the sense of how big the damages are, and then also gives a sense of how much the government is picking up of those damages, how much the government is actually paying for. So starting accurate post-disaster damage assessments and recording, and I know work on this is ongoing with OECD as well. I think it's a very important step to have the historical loss and damages database as well. Thank you.
Yeah.
I think a final point from me is really just to reiterate a message that both my colleagues mentioned, which is around the establishment or nomination of a dedicated unit that is actually leading this work that Benedict just mentioned. And so this was one of Rong's final recommendations towards the end of our presentation. But I think that there is a need here to have a unit that, as Benedict also mentioned, this does not necessarily have to be the creation of a new unit, but there does need to be a unit which is responsible and accountable for this kind of work, rather than disaster risk just being considered as a sort of an afterthought or an ad hoc thing that someone needs to look at. These are real risks to the country and the ongoing economic development. And so I think really one of the key kind of lasting recommendations is around the need to really embed this analysis and this work stream within government for the long-term future.
Thank you. Director Bacani, Director Clasara, yeah.
Yes, ma'am.
If
I may, if I may lang, I will, in my latest statement, I highlighted that we push for the creation of the Department of Disaster and Resilience that would respond to the issues raised on fragmented expenditures, fragmented accountability, fragmented reporting. You don't capture the total expenditures that we spend or we invest in. So the DRR is we push for it. And for the insurance, we had been providing for insurance since 2017. So it's high time that we make a review of what how efficient or how effective are we in those investments since 2017, and then we proceed with at the same time we proceed with the inventory of all government assets, and then we can now decide whether do we scale up or not, and what would be the proper insurance type of insurance. Will it be parametric? Will it be indemnity? That would depend on the study that would be made since we had the insurance in 2017. I think that's for the debate. Thank you.
Thank you.
On the part of COA, Pamela,
Yes.
I think there should be an office or a unit dedicated to audit only the disaster fund. So on that regard, the Office of the Disaster and Resilience, which the Congress is proposing, would be very helpful. The auditor assigned at that office or that department would be the one who has the responsibility to audit all the disaster funds, in as much as it is composed of the three sectors. The national government sector, the corporate government sector, as well as the local government sector. So with that office or with that department, it would be consolidated. all the funds will be consolidated there and recorded. Another thing, I wish for those who are not compliant with the reporting standards, as well as those who spend disaster funds for the purpose for which they are not supposed to be expended, there should be I guess a harsh penalty for them. Maybe in the law we could include that penalty clause so that we could really have a whole picture of what disaster fund is really all about. Thank you, Pamela.
Thank you. Thank you to all our resource persons, Ron, to Benedict, Richard, Director Bacani, Director Clasara. Thank you. And to all our participants who have stayed on until the end of our activity, thank you very much. But let me hold you for a few more minutes. Now let me give the time to the Executive Director of the Budget and Tax Research Bureau of the CPBRD, Novel Bangsal, for the closing remarks.
Thank you, Pam. I know you have a lot more questions you want to ask, but we will try our best to share those questions to the World Bank and draw as much possible answers and insights as we possibly can from them. Uh, so, if there's any key takeaway that we can draw from our in-depth discussion is that the Philippines is at risk of being overwhelmed by multiple concurrent shocks. But there's hope in the horizon, and that is to prearrange public financing to respond to future crises holistically. It is important for us to build a shock-responsive fiscal planning that can help build resilience against future shocks. In the final analysis, building financial resilience will require not only appropriate financial instruments, technology, and delivery channels, but also a supportive institutional environment. And on that note, allow me to thank again in behalf of CPBRD, a list of people and institutions. First, to Honorable Representative Lucy Torres Gomez, who have been very supportive and active in our dialogue on disaster response and recovery. To our distinguished speakers from the World Bank, to Rong Kian, who will be joining us again on our next webinar on June 16, to Benedict, who has been, as usual, very generous with his time and insights to us. We hope to see you again sometime. And to Richard Walter for sharing his extensive know-how on pandemic and disaster risk financing. Our thanks also to other World Bank team, to Leslie Cordero, Attorney Beng Palanca, and in particular to Dina Villasin, who has coordinated this activity with us since the beginning. And to our panelists, the DBM Director Cristina Larasa, and COA Director Michael Bacani, for taking time to give their perspectives from the government lens. And finally, to the World Bank, our partner in the Knowledge for Development community. We also would like to thank our participants to this webinar. And for everybody's information, the CPBRD and the World Bank will be holding 2 more webinars this June. If you can please flash it on screen. So we'll be having another webinar on June 14, a briefing on undernutrition in the Philippines, and another one on June 16. This will be on the Philippine Economic Update, June 2021, with focus on the fiscal impact of the Mandanas ruling. So we will be uploading all webinar materials, including the highlights of the Q&A on our website at cpbrd.congress.gov.ph. We'll be flashing this later on. This webinar will not be possible without the efforts of the CPBRD team, the Budget Policy Research Service, led by Director Pam Diaz Manalo and Jules Dumangas, and the publication and admin group led by Director Ringo Gamboa and Alex Taaka, and all to our team who had with their efforts and time, we extend our deep gratitude to all those who participated. So again, thank you, and we hope to see you in our next webinars.